This is the final bar. This is Michelle Schneider, Mish, Chief Strategist of MarketGauge, filling in today for Dave Keller, who was a little bit under the weather. Fascinating day in the market. First of all, much mentioned, it's Columbus Day. So even though the stock market was open, the bond market was closed today, as were banks. So it's interesting, the reaction of the market, given the fact that we woke up over the weekend to see that Israel had declared war. One would have thought the market would have gone down, but instead we closed with a lot of green. Why? Well, there's a few reasons. One possibly could be that people have an expectation that the war in Israel will not last very long and not impact globally as much as people initially feared, thereby not necessarily affecting how we do here in the United States. Number two could be that also this week we have CPI, PPI, and a Fed meeting. And it's possible that people feel that at this point, inflation, although we saw some higher numbers last time, are near peaking. And in that case, they feel that the Fed might actually wind up pausing. Lots of predictions for 2024 having actually a rate cut at this point. However, if we look at all the evidence of what we have right now, with the bond market closing and the war really being very uncertain at this point, it also could be that the TLTs, which went up today, also are more recessionary looking, and people are afraid. And this was more of a short covering after holding some key technical levels last week, particularly in the economic modern family. So why don't we take a look at the charts and have a look, see if we can figure out where we might be going for the rest of the week. Okay, so if we start here with the S&P 500 chart, and I'm going to be showing the ETFs, just because I think they give us a lot of information. And particularly if you look at this chart, we see all these different indicators we have here. To me, what's most interesting is, first of all, the breakdown under this red horizontal line, which is our July 6-month calendar range. So clearly, in terms of the ranges, we're in a bit of a downtrend. However, when the SPY fell off, we did hold the 200-day moving average. And now with this pop right here, what is also interesting is after we held that, we also had a mean reversion on our real motion. So essentially what we can say at this point right now is that we have a good range. 420 is obviously a very big area, lots of people watching for the support levels. And then if we can get back up over this calendar range high of 436 to 437, then our next area would be looking at, of course, would be the 50-day moving average. So we are in a caution phase. We are below seasonality where we would expect coming out of a weak season in September. And yet, given all the negative news, we're actually doing pretty well. Although if we take a look at the momentum indicators right here, what we do see is that there's a bearish divergence in that this is under the 200-day moving average in momentum, even though we're above it price. So it could be also that we just go into some kind of trading range right now until further evidence between 420 and 440. If we move over to Qs right now, essentially it's a little bit of a different picture. First of all, with the Qs, we are well above the 200-day moving average. And today, growth stocks, no surprise, because they're always where people go during a rally, are well outperforming the SPY. And we can see that here in the relationship with the leadership indicator, even though we're still working a little bit of a mean reversion sell signal. However, we're back over the July 6-month calendar range low, that red line again. And here we are approaching the 50-day moving average. So we could easily say that if this market gets through 368, particularly in the growth stocks, that's a real positive. It also means that maybe this has been an all bottoming action. Also, if we take a look at the momentum, still a bearish divergence because we are well over the 200 where we're just crossing it here in momentum, but we are crossing it. So two things we want to see. One is a phase back to bullish. Two is that we hold this 363 to 365 level. That's kind of pivotal. And four is that we want to see the momentum improve and eventually take out the 50. That would be the best case scenario. It would also mean that the market, from people who are looking at a fourth quarter rally and also a huge rally into 2024 based on a pre-election scenario, would be getting it at least in the growth stocks, which is why we always have to look at IW. So now this is my small caps. We know that they are very much underperforming the market. We can see here that this is under everything. We are in a distribution phase in that the 50 is still above the 200 and prices below both moving averages. And of course, this broke down under the 6-month calendar range low. However, we could be having somewhat of a reversal here. This is going to be so key in the market. And hopefully, if you take a look at the 80-month moving average, and if I don't have time to show it to you today, you can look at it on my daily. It is showing you that 170 is such an important level because that is an 80-month moving average or a 6 to 7 year business cycle, which if it breaks, even though Qs right now and SPYs are looking so much better, it will have an impact and point more to a recessionary scenario. So at this point right now, all we can say is that we were saved by the line in the sand at that 170 level. We're not nearly doing as well as what we're seeing in NASDAQ and in SPY. And of course, this is really going to reflect the U.S. economy. And we have a ways to go. We get back over 177. That's a good start. Obviously, you can see we have a lot of congestion here between the 6-month calendar range low, the 200-day moving average, the 50-day moving average, and then eventually up here, the 6-month calendar range high. So 177 really to 184 is our major resistance. And like I said, we break down under 160 with this negative underperformance in the SPY and also a death cross that we're seeing in momentum, then whatever rally we're seeing right now everywhere will be short-lived. If we move on very quickly, and I'm going to go a little faster here, XRT, of course, is the other one we have to watch, which has been underperforming the entire year. This never took out a 6-month calendar range high. It never took out a 23-month moving average. However, it had a very clutch hold of that same 6 to 7 year business cycle or 80-month moving average, even though you're looking at a daily chart right now. Also, obviously, well underperforming the SPY. And from a momentum standpoint, and also from a phase standpoint on the daily, we're in a bearish phase. To me, a bearish phase is when the 50 is below the 200, and we are also seeing at the same time price below, and the same thing in momentum. If we're seeing the 50 cross below the 200, which we have, so we have a bearish phase here in both. What does retail have to do? Really, at this point, if we take a look at all this action right now, we really want to see this get back over 61 to 61.50 before getting too optimistic anywhere. And of course, holding that 57 super key. We also, though, have to take a look at IYT. That's the transportation sector. And again, this one doing better than Granny. It's under the 200, but it's still only in a distribution phase, obviously underperforming the SPY. And also you can see here momentum not looking that great. But once again, if we can get through that 235 or back over that 200, well, let's even call it 235 to 236, that would be a good start. And then we would have to take a look at what happens up about $10 higher at 245. And then last, in terms of the modern family that I'm going to show you today, is going to be semiconductors. Semiconductors, obviously a big part of the growth stocks. Now, what you can see here is this is outperforming the SPY as it has been, yet we have also a bearish divergence in that this is above the 200-day moving average, yet here it's below it. We're getting close to a potential death cross here. So momentum is telling us not so fast. Price, though, is telling us that we're flirting with the 6-month calendar range low. So really, we have to say 150 is going to be a magical number for the semis. We get over 150, that would be a really good sign. On the flip side, of course, with recent lows at 140, we'd want to see that hold. Now, what's really influencing the market as well here, considering the news of the day? One would be oil. Well, since I don't have a futures chart here, I'm going to show you a USO. You can see that the barrel of oil went up to about $85, $86 a barrel after it had already gone down to about $76 a barrel. In the USO, it is underperforming, and in the momentum, it's not necessarily in line. Little bit of a divergence between the momentum under the 50 and price, which popped back over the 50. With this gap down, you want to see this get back through like 79.25 or 80 before we can start to say that today wasn't just some knee-jerk reaction because of what's happening geopolitically. And of course, that would be able for us to see if A, we don't fill this gap up to around 79.20, B, if we wind up failing back under this 50-day moving average. So right now, oil, even though people are saying the surge is inflationary, it's not where it was even just a couple of weeks ago. And we also, of course, have to take a look at gold, which also had a big rally today. So looking at the gold chart, again, this is GLD, but we know that the futures went past 1,865 in the DC contract. That was a big number. So what we can see here is this too is underperforming, had a mean reversion a few days ago. In terms of the actual momentum indicators versus price, this is in a bear phase, as is this, so there's no real divergence. So gold needs to prove more to us as well. I think that at this point with gold right now, again, 177 is really where it broke down from. Until it gets back through 180, it's not all that exciting. But if we look at the futures, 1830 was your rock bottom support. 1865 is now pivotal. We want to see what happens at around 1900. And then, of course, we'll take it tranches from there, 1950. Overall, though, we also have to say is that we did have pretty much of a gap down and a gap up, leaving a several-day island bottom here or exhaustion bottom. So we can also say that the move in gold would be over if, let's say, we break down under 170.23 and fill that gap. For right now, to me, the risk is more to the upside, in that we'll be looking at what happens here up and around 177. And finally, I want to show you TLT. This is a very important chart here because obviously the yields have done nothing but go up. But today the yields relaxed again with the bond market being closed. So what would potentially get me more bullish in this? Well, first of all, if I throw in a 10-day moving average in here, what you can see with this moving average right here in this cyan line is that we have not been above the 10-day moving average in the TLT since September 1st. So we've gone basically almost 6 weeks underneath the 10-day moving average. However, we also had a mean reversion in the last couple of days with looks like kind of an inverted doji low. So now we are more to the upside. So at this point, I think also you'll really get a better picture of what the yields are going to do when the bond markets open if we can actually get a move and close above 87 in the TLT to the upside. And if not, then maybe this was just a quick short covering rally. Obviously, you don't want to see these bonds rally too much because you don't want to see them start to outperform the SPY. Because when they do outperform the SPY, that goes from a risk on to a risk off situation. So to sum up, in this very uncertain time, we still have pretty much a divided market that we have seen for pretty much 2023. We have the growth stocks, which can continue to lead, but we have the small caps that can act as an anchor. So what you really want to watch for as we get through this week is what pulls up what or what pulls down what. And then, of course, if we go to those sectors, the retail sector still has to show some kind of consumer confidence, another number that comes out this week. And then finally, really have to take a look at the bonds, since the bonds have ruled a lot of the bias of this market. If the bond market eases here, does it ease along with the SPY, which in case both can go up and that's fine? Or does it start to outperform, which tells us that on the basis of the fact that the small caps and the retail are underperforming, regardless of what the SPY and the Qs are doing, if the bonds move up and start to outperform, that means that basically things aren't as good as they look today on a Monday, where we got an amazing pass given all the negative news around the world. Hope this was helpful to you. You all have a great afternoon. Thanks so much, and bye for now. This is Mish Schneider signing out.
So the secret to becoming a millionaire